Welcome to Bloomberg Markets. I'm Scarlett Fu. We're looking at U.S. stocks bouncing back after the S&P 500's worst start to a September since at least 1953. So let's take a look at where things stand right now. You look at the S&P 500, it's been a straight shot up since about 11 a.m., sitting at a session high right now. Financials are leading the advance. You look at the Mag 7, they're also in recovery mode. Apple, a bit of a laggard though, before its big product launch event in the next hour. And not much action going on in treasuries right now. You could see that the 10-year is sitting at 3.70%. Worth noting that there is competition from the corporate sector. There are 7 potential issuers looking to sell U.S. investment-grade bonds today. And minimal moves here in currency. The dollar, however, is higher against most of the G10 currencies. And I guess you could include the euro in that category. The European Central Bank, of course, expected to cut rates at its meeting on Thursday. But let's go back to the price action in equities with a check-in on some midday movers, because after the close on Friday, S&P Dow Jones Indices announced it is adding a few companies to the S&P 500. They're Palantir, Dell, and Erie Indemnity. This goes into effect before the start of trading on Monday, September 23rd. You can see the shares gaining on anticipation that passive index funds will need to buy them. And these 3 companies will replace American Airlines, Etsy, and Bio-Rad Laboratories. Keep an eye on these moves, as index funds will need to sell the shares to realign with the S&P 500's new composition eventually. Now, when it comes to the Fed and the economy, investors will, of course, be watching for inflation data. CPI and PPI are set to be released this week. Renaissance Macro's Neil Dutta spoke earlier about where the Fed may go from here.
The important story is that I think the economy is evolving in a way that the Fed may not be anticipating. And to the extent that that's true, I think it creates the risk of an accident later, which is something we've been arguing, obviously, since June. And the only reason to expect 50, and yes, I still believe that a 50 basis point rate cut is possible at the September meeting. That's our call to our clients, is because of Jerome Powell. We can talk about Waller, New York Fed President Williams. All Jerome Powell needs to do is get out there and before his colleagues around that table and say, I think we should go 50, and they'll all fall into place. And in fact, a lot of the people on the street that have 25 basis point rate cut calls, they'd have no problem with the Fed going 50 either.
So clearly the debate continues over the size of this month's Fed rate cut, especially on the heels of the jobs report on Friday that really failed to establish any kind of broad consensus. So for more on the equity markets, let's bring in SoFi's head of investment strategy, Liz Young-Thomas. Liz, do you think that with the CPI and PPI releases we're getting this week, we're going to get clarity, we're going to get a clear idea out of the data on whether the Fed goes with 50 or 25, or will it be kind of a guessing game all the way to the very end?
Well, that labor report from last Friday was supposed to be the linchpin that helped the market decide whether they were going to do 25 or 50, and it didn't really serve as that. We actually saw the likelihood of a 50 basis point cut go down throughout the day on Friday. So we're sitting here in limbo again, which I think means that the CPI report will be more important than what we were expecting. If you look at just the market implied moves on Wednesday after the CPI report, they're much smaller than what we used to expect on a market move on a CPI day. But I think this week it will matter. If that CPI data comes in cooler than expected, I think 50 will get priced in pretty quickly. And I do think it matters. I agree with that previous guest. I think that there is a good possibility that they do 50, even if the market is unsure of whether or not we're going to receive a larger cut.
And if they go forward with 50, is the assumption then that the Fed will need to stick with 50 basis point moves at every meeting? Because how do we figure out the cadence of future rate cuts moving forward?
Yeah, so I think if I were the Fed, I would be thinking about this more so along the lines of what's the bigger risk? And the way that I see it is the bigger risk is actually doing 25 at the September meeting, because there is no meeting in October. And there's a lot of time between that September meeting and the November meeting, which is after the election. And they don't want to run the risk of looking too far behind. So we're going to get a decent amount of data between that September and November meeting. If they go 50 in September, perhaps they look reactionary to some of the data that's already happened, but they can manage that message. I think it's much more difficult to manage a message of, okay, we missed it, we were behind, and now we have to play catch up later on.
So let's talk a little bit about equities, because we know September is historically an unkind month to anyone who is long the U.S. stock market. And that's exactly what we got last week, with the S&P 500 losing about 4.25%. How do you see the rest of September unfolding?
Well, it seems like every week in September we have some kind of highly anticipated event. So unfortunately, I don't feel like the volatility is really going to subside through the end of the month. Obviously, we have CPI this week, we have the Fed meeting next week, and we had the jobs reports last week. So there's a lot going on. There's a lot of uncertainty. Not to mention, layered on top of that is the fact that this is an election year, and September does tend to start to see volatility going into that election. And in an election year, that volatility tends to stretch out into early to mid-October. So I think that the moves around and the gyrations that we've seen in the market are probably here to stay for a couple more weeks.
Okay, I look at the internals, and I look at how the sectors are performing over the past 1 month. And we've seen value sectors outperform: financials, consumer staples, REITs, even utilities, up at least 5%. Utilities up about 3%. Do you see these as the new leaders, or is this something that we're going through as we're in kind of mid-rotation?
I see these as rate plays. So if you look at the 1 month period of performance, as you just mentioned, versus the year to date period, you've got consumer staples up there in either the 1 or 2 spot. Utilities fell down over the 1 month period to, I believe, the number 5 spot in sectors. But that's because utilities had benefited a lot from the AI enthusiasm, and they were seen as an adjacent trade to that AI enthusiasm. So as some of those companies have given some back, utilities have given some back too. But the environment that we're in, and the environment that we're likely to stay in through fall, is now we've got a yield curve that is just marginally uninverted at the 2s, 10s, and we've got a cutting cycle that we're embarking on. It's been a very long time since we've seen that. So yields have fallen. I think the short end of the curve will continue to fall, meaning the 2-year and shorter will continue to fall as the rate cutting cycle begins. And some of the sectors that are doing well are ones that you typically do see do well during what's called a bull steepening environment, where yields fall across the curve, but the short end falls faster than the long end.
And I'm so glad you bring up the 2s, 10s spread, because it is positive, and it's been, I think, 2 trading days since it's been positive. But obviously, we're still seeing the 3-month 10-year yield curve inverted. What does that tell you in terms of where expectations are headed?
Well, the uninversion or the re-steepening of the 2s, 10s suggests that obviously the 2-year yield is what tracks the Fed funds expectations more closely. So as we get closer and closer to that first cut, it shouldn't be a surprise that the 2s, 10s spread did get into slightly positive territory. Now, when we're talking about positive, we're looking at 3 basis points right now. So this is not remarkable, but it is a big move from where we were about 6 months ago. The 3-month 10-year spread, interestingly, is the one that the Fed usually talks about as their most preferred spread to watch. And that one's still being quite a bit inverted, over 100 basis points, suggests usually to them that a recession is more likely than in a normal environment. So we can bet that the Fed has been watching that curve, although that one continues to stay very deeply inverted. And it is a concern. It's one of those little things that keeps me up at night.
Yeah, and I'm sure it's something that clients ask you about as well. SoFi's head of investment strategy, Liz Young-Thomas, thank you so much for joining us today.
Thank you.
Coming up on Bloomberg Markets, Boeing shares are rallying today on optimism that a labor deal with its largest union could help steer the company away from a strike at Seattle factories. It is our stock of the hour, and it is next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour, and we're watching shares of Boeing take off today after reaching a preliminary deal with its largest labor union to avoid a strike. Workers will vote on the deal later this week, with most analysts optimistic that it will be approved. So joining us now for more on this is George Ferguson. He is Bloomberg Intelligence Senior Aerospace Defense and Airline Analyst. George, what would you say are the odds that this will definitely go through? Because it's not a done deal, and the membership could surprise us.
Sure. I think it's probably a better than 50% odds that it will get done. But we are seeing a bunch of chatter in social media that there are members of the union that aren't happy with the agreement. I mean, it's the agreement between their leadership and Boeing, that is. I mean, the pay increase is 25% from what we've seen. And Boeing said with progression payments, which I guess are, sort of internal pay increases over time, it's like a 33% increase. The union had come out looking for 40%. So there's a bit of a gap between that. And that may be some of the reasons people are disappointed. But I think it's probably still better than 50% chance it does get approved by the rank and file.
Okay, and the vote is scheduled for Thursday, I believe. Now, if this does go through, does the new CEO, Kelly Ortberg, deserve the credit or any credit?
I mean, look, I think he had some influence on the negotiations, but he's just in the door, so I don't think he's the big reason why this deal gets done. Look, I think it comes down to economics for the union, right? The union, under a contract now that had much lower pay increases, they've seen a bunch of inflation over the last number of years. So I think they really wanted something that would make their membership, get their membership whole with where prices are in the general economy. And on top of that, they secured an agreement to at least keep the next airplane in the Puget Sound if it's announced during the 4 years of the agreement. I think that was important to the membership. So I think the economics of the deal is what's really going to win the day and not Kelly Ortberg.
Got it. Now, eventually, when this deal passes or a deal passes, Boeing is then in a position to address its financials, maybe shore it up. What do you expect it to do? There's been talk of perhaps a share sale.
Yeah, so I think they want to obviously avoid a share sale, right? Because that can dilute the existing equity. Nobody's ever happy with that. They don't want to add more debt to the balance sheet right now. I mean, look, I think that if they get this deal done, that they can start to deliver airplanes, right? Without workers, you can't deliver airplanes, which will help their financial performance. So they may even wait a little bit, as they try to spool up the factory, get airplanes delivered, generate cash, and see if they can work their way out of this. Without an agreement, they can't. And my guess is if they get into a bind here, they'll probably need to go to the equity market so they don't mess up their credit ratings too much.
Yeah, good points. George Ferguson of Bloomberg Intelligence, thank you so much. I'm looking at Boeing shares, very actively traded right now. The volume is about 80% above the 20-day average. So that is why it's part of our stock of the hour today. Coming up, we're moments away from what many people are calling Apple's most important event of the year. We're talking new devices, AI integration, all against the backdrop of regulatory battles with the U.S. and Europe. We go live to Apple Park in Cupertino next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We are just moments away from an Apple launch event where the company is expected to unveil new iPhones, wearables, and, of course, talk about AI. Bloomberg Technology co-host Ed Ludlow is at Apple Park in Cupertino, where the event will soon begin. Ed, this thing usually follows a bit of a script. Tell us what you're expecting to happen.
Yeah, that's fair to say. It's highly choreographed. I mean, you hit the main elements, which is a refresh to the generation of iPhone 16, 4 variants of it, 16, 16 Plus, Pro and Pro Max. But, it's interesting because as Mark Gurman of Bloomberg's reported, you probably won't have a sort of high level of hardware upgrade generation to generation. And so with that in mind and the context that Apple Intelligence, its AI offering, is having this kind of delayed and staggered rollout, it comes down to the simple story that Apple executives tell to the average consumer. Here is how we think you'll use generative AI technology on your handset, and therefore why you should upgrade to the new generation of phone.
And how quickly will any Apple iPhone user actually be able to use the AI that Apple is going to be talking a lot about? I mean, what's the earliest that anyone will have that in their hands?
Yeah, so the timeline that we understand is that after the 16 handsets are unveiled today, they'll start shipping at the end of this month, September. iOS 18.1 likely rolls out next month in October, but there are specific sort of staggered or delayed elements of it. So we know that OpenAI's ChatGPT as an integrated facet of Apple Intelligence won't come until later, either at the end of this year or early next. And some of the image generation tools have also been delayed. So it's a very much staggered approach. And if you look at the sort of the industry forecast for handset shipments, most people expect iPhone sales to be flat to 1% growth this year, while the overall market grows 6%. But it's next year where that growth in iPhone handsets picks up, 25, where you have 4% growth, IDC's forecasting, because the impact of Apple Intelligence will be felt later. Consumers need time to understand it, Scarlett. I'm not sure I even know yet how I'm going to be using AI on my phone, and I kind of talk about it every day.
Yeah, I know. That's a good point. And I wonder, given Apple's efforts to make the Vision Pro a big thing, and it hasn't really, partly due to its price point, is there concern at all that the Apple Intelligence and the AI products that it plans to infuse into the new iPhone will just kind of be met with a big collective shrug?
It's interesting. The first place you look then is the price point of the Pro model in particular, and whether they decide to raise prices in order to lift overall ASPs. We had Seema Shah on the show earlier, and one point she made is look at middle and higher income earners right now. The data's strong. It's really in the low income households, particularly in North America, where there's some pressure on the consumer. And so it comes down to technology. There seems to be a lot of enthusiasm from consumers for AI in the markets where they have spending power. But remember one key thing, which is China. Apple Intelligence will not be available in China in the first instance because it's not approved by regulators. There is a strange paradox, though, where there's evidence that consumers in China may upgrade anyway with the hope that it comes at a later date.
Got it. Ed, really appreciate your taking us through all of that. And of course, Ed Ludlow, Bloomberg Technology co-host, is going to be on site when they actually announce all the new products or new product iterations. We're going to stay with Apple here because this event comes amid a slog of regulatory battles that the company has faced both in the U.S. as well as abroad, notably Europe. So for more on what's at stake, let's bring in Angelo Zino. He specializes in recommending investments within the tech sector, and Angelo is VP of Equity Research at CFRA. Angelo, it's good to speak with you. Clearly, Apple is dominant in the smartphone industry, and the latest iterations of the iPhone, the AirPods and Apple Watches is designed to keep it at the top of the pile. And we know Apple calls the shots with its suppliers, with app developers, and investors don't really have a problem with that. The stock has done very well. They've been rewarded for that, but regulators are not comfortable with this. At what point do investors start feeling uncomfortable because of the regulatory scrutiny?
Well, thanks for having me. So as far as kind of the regulatory tilt to all this, I don't think investors necessarily. I don't want to say they're kind of numb to the regulatory issues that are out there, but in many respects, many of these mega cap tech companies, specifically Apple, have found ways to kind of successfully circumvent a lot of some of the regulatory pressures that are out there. So until it actually has an impact on the actual bottom line, investors are going to likely continue to, I don't want to say, again, be numb to it or ignore it, but they're probably going to put less weighting to some of the regulatory issues out there until it actually impacts, again, that bottom line. And we don't see that, taking place here over the next 12 to 18 months. So at this point in time, it's not something that, we expect to have an impact on that stock.
Okay, so investors are willing to look past it because it's something that will take time to unfold. And even when it does, Apple will have figured out a way to maximize or optimize the situation for itself. Is this something that you get asked from clients about ever?
We do get asked about it a lot, actually, in terms of some of the regulatory pressures, not only for Apple, but for other mega, cap names out there. But again, typically you have a longer tail associated with many of these regulatory hurdles out there. And again, most of the customers or clients, investors that we deal with are at this point in time kind of willing to look past some of those issues. Okay,
got it. So they're more concerned, obviously, about things like the Apple launch event, which is taking place today. What are you seeing or thinking about in terms of the pricing for this new iteration of the iPhone 16, which would open the door to AI-enabled devices?
So for us, pricing is the biggest key as far as this event is concerned. We do think kind of, most of the most of what investors need to know kind of going into this event has kind of largely played itself out outside of maybe the timing of certain AI capabilities that hopefully we get some details about, as well as pricing. Last year we did see a pricing hike in terms of the Max, kind of their highest end device, and this year what we do expect them to do is again kind of be more modest in terms of the pricing hike. We're only modeling a $100 increase in terms of the base Pro device up there, just to kind of get closer to that Max price point. You have a $200 divergence, so get closer to $100, mostly because we expect them to kind of add some of the capabilities that they had on the Max side of things to the Pro in terms of kind of better camera capabilities, as well as greater memory in terms of doubling that memory content. We do think on the standard devices, they keep that unchanged because of kind of some of the macro pressures that are out there. And we think consumers definitely are still price sensitive at this moment in time.
Yeah, absolutely. And a lot of talk that the iPhone 17 might actually be the bigger deal. Very quickly here, Angelo, do you think that'll be the case, that the iPhone 17 is where we should really focus?
So we continue to be, more in the camp that this is going to be more evolutionary than cyclical in nature. So yes, I mean, we do think this is an important upgrade cycle, because the last time we saw a really great upcycle was the iPhone 12, and that was kind of 4 years ago. So we do think this will be a good upcycle. Mm-hmm. We're looking for unit growth of about 5%, but that iPhone 17 we think will be even more impressive because of some of the capabilities that developers are going to be able to kind of have, and roll out.
All right, good stuff. Angelo, really appreciate your joining us today. Angelo Zino, the VP of Equity Research at CFRA. And I'm Scarlett Fu. That does it for Bloomberg Markets. We will take you, of course, to Balance of Power next, but also keep an eye on the developments at the Apple launch event. This is Bloomberg.